then. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us on the show right now with his views. Mihir, thanks very much for joining in and good morning to you. Lots been happening across the globe, bearing down its impact on our markets as well. You've got the currency in a tizzy, commodities have sold off, equity markets now somewhat, though we've been resilient, we can't probably withstand the collateral damage of what's been happening globally. What's your sense?
Yes, I think the next few weeks are going to be challenging, given all the moving parts that are there locally as well as globally. Locally, of course, we had the trade deficit data, which also doesn't look very healthy. So on the whole, I think it's going to be choppy times for equities as well as the fixed income as well as currency markets. So I think all markets are in a tizzy, I would say, and better to wait it out and see how all this pans out in the next few weeks.
The trade deficit numbers closer to 5-year highs. Do you see that building up more pressure for the CAD and the currency, in that sense?
Yes. The other thing to remember is that we have seen a lot of fixed income portfolio flows in the last 4-5 years because our real interest rates have been quite high, and we are beginning to see the reversal of those in the last few months. So the trade deficit combined with sustained FII flows from debt and equity may put further pressure on the currency. So that is something that we need to watch out and see how the RBI responds to that.
Mihir, good morning. Neeraj here. Assuming with an assumption that even if the RBI intervention were to come in, the natural course might just take the rupee slightly lower. It's a hypothesis, but if we work with that hypothesis, what's the impact that it has on markets by and large? I know foreigners by and large, even despite the 12% uptick on the Nifty, wouldn't have made any money with dollar-denominated returns. The same is not true, of course, for you guys and the domestic mutual funds. But what happens if the currency were to weaken further?
So it's a question of the trajectory, I would say. If the currency weakens in a steady fashion, I think it's fine because people can build for it, people can hedge and kind of account for the hedging costs when they are looking at Indian equities and fixed income. So that's fine. It's when you see volatility and sudden movements in the currency, that's when people kind of stop and reassess what they need to do with the long-term view in the country. So I think a steady depreciation is fine because we are running a current account deficit all the time and the trade deficit, which is much larger. So having said that, the currency should naturally weaken over a period of time. So it's a question of whether it's sudden, like a shock, or whether it's more moderated and controlled.
Mihir, in which case, what happens to the big elephant in the room, and that is crude? If that were to turn around, I know it's been soft over the last 1 odd month, but very choppy and volatile. If crude were to worsen, are markets now extremely vulnerable? Yes, the earnings are strong, but we are perched in or around the new highs with the currency at 70, 72 as the case may be. If crude were to make a comeback, does that make our markets extremely vulnerable to some downsides?
Oh, absolutely. I think crude is the single biggest variable for India. Whether you look at the fiscal deficit, the trade deficit, the inflation number, the currency situation, the fixed income markets, it's ultimately directly or indirectly all linked to crude. And thankfully, from the peak of 80, it's stabilized at closer to 72, 73, and hopefully it won't go up any further. Having said that, there is a good chance that given the ultimate potential supply of shale, etc., we won't see upside rather than compared to a downside. So I think if you were to ask me, the probability of crude stabilizing and drifting a little lower is probably higher in the next 1 year or so than it going to 80. Fingers crossed, of course.
All right, that works. 75% of the jump in the deficit this time around was because of the crude oil imports. And remember, currency playing a very important role, at least on this side, because every 1 rupee change against the dollar hurts the import bill, the crude bill, by $1.58 billion. So, that could overall have a big macro impact. Coming to markets, and the kind of activity we've been seeing on the foreign investment side, the pickup has been recent. You've not been seeing them in the markets for a really long time. Recently, they started to pump in some money. Do you see the allocation to emerging markets increasing from the foreign money side?
As far as the recent few months are concerned, we are seeing outflows continue from emerging markets, both in equity funds as well as in bond funds. And that, I think, is a broad function of rising US interest rates and the fact that the US equity markets are doing quite well. So to the extent that we believe that the US is still on a rising interest rate path, we might continue to see weaker FII flows than before for the next few months at least.
Mihir, earnings by and large, I mean, say for SBI, we were just doing that piece this morning. If we remove the SBI exceptional loss, the actual EPS for the quarter, bang on in line with what the estimates were at the start of the quarter. Has it been heartening for your coverage universe or the companies that you guys are invested in?
Yes, so far the earnings trajectory is still in line. Though having said that, we have seen downgrades over the last 6 months at least. So hopefully by this quarter we won't see any further downgrades. So I would say that yes, mostly the private sector has done well, while the public sector overall has not done so well. That's been the trend so far.
But your conversations, Mihir, with companies or the calls that your team would have analyzed, do they give you confidence that leading into quarter 2, quarter 3, while the reported numbers might be lower than quarter 1, but it's broadly in line with what you guys were anticipating?
So far it looks like yes, especially on the consumption theme, which continues to remain strong. So if we look at the private sector financials, which are catering to a lot of consumption demand, NBFCs as well as private banks, if you look at automobiles, etc., it looks like the trends are still broadly in place for the consumption theme. I think we might see a little bit of tapering off from the infrastructure-led pack, not so much on the earnings, but from the incremental order book growth for the next couple of years. So that's something that we need to watch out, whether the strength of government spending continues or it's wearing off.
What did you make of the entire banking pack earnings? And now that we're looking at big heavyweights like SBI actually upfronting most of the provisions and saying that the next few quarters to come will actually be positive since they've already upfronted most of the provisions.
Yes, so as far as the corporate-led or corporate-biased lenders are concerned, probably on the private sector side, the worst may be over, and we might see some return back to growth by those banks. So that is one trend we probably should watch out in the next quarter or so. And the retail segment continues to do well. While growth continues to be robust, we are not yet seeing any major signs of stress on the small ticket retail. There is some inkling that the SME segment might be seeing stress in pockets, but probably it's too early to take a call on that.
The consumption theme this time around playing off well, according to you?
Oh, absolutely. I think that's the only theme, apart from, as I said, government-led lending, that's holding up the economic growth. CapEx is still not picking up. And the whole host of segments linked to consumption, like the private sector NBFCs, private sector banks, automobiles, paints, affordable housing seems to be doing well, and we are seeing a lot of action. So probably you might see some pickup in cement demand because of that. So yes, I think the consumption theme as a whole is still robust, and I expect it to remain robust because of the election year syndrome. We don't expect government to let loose on the feel-good factor for the consumer, at least till the elections are over.
It's an interesting point you raise up, Mihir. Cement, the numbers chalk and cheese this quarter, save for the Wholesome Group. The others didn't quite live up. And well, the theory, at least about a quarter ago, was that the big demand push that will come in for cement has gotten pushed by a year at least, if not longer. Are you getting the feelers that the demand may surprise on the upside, if not in quarter 2, then at least starting quarter 3 onwards?
Yes, and it may largely be linked to the affordable housing pickup. So, as I said, there is good pickup on the affordable housing, especially on the rural side. And if that trend continues, you may see some upside surprise. Because if you look at the aggregate cement demand, bulk of the demand actually comes from housing. It's not so much of government capex, etc. And of course, a lot of it is rural housing. So if rural housing and semi-urban housing picks up because of the government scheme, and there are some signs that it is, then you might see cement demand, getting robust as we go forward in the next couple of quarters.
Commentary bullish from IT by and large, Mihir. Add to that the rupee tailwind, and I believe the presumption is that natural slide of the rupee is underway as well. Do all of these factors augur positively for the listed stocks?
Yes, the currency of course will help the EPS expectations, but more importantly, in volatile times you anyway see people switch to defensives, and IT is considered to be a defensive. So I think in times when we are seeing uncertainty on flows, on currency, it is natural for the markets to move to FMCG, pharma, IT kind of segments, and that's what we have seen in the last few days.
With what the crude is doing and what the rupee is also doing, you think it'll have a meaningful impact on some of the oil marketing companies?
Oil marketing companies, we used to like them a lot, and of course we've kind of suffered a bit because of that. The problem is that there is complete lack of belief on consistency of probably policy towards these companies, and that's the reason why these companies have seen a significant derating in the last 6 months. So even though marketing margins may be robust at this point in time, markets are not convinced that these margins will continue or will be allowed to sustain. That's the reason why you see the entire OMC pack as well as the government PSU upstream pack also not really participating in any form in spite of crude prices moving either ways.
Subsidy burden will weigh down on them?
Sorry, come again?
The subsidy burden for some of them. Do you think it'll be large enough for them to actually see a meaningful dip in terms of the share market prices?
So that's the issue. The market doesn't know what the final policy on subsidy sharing is going to be, because beyond 70-75, the required increases in petrol and diesel prices have been kind of not so automatic, and that's the reason why the market is concerned whether they will be able to withstand a further upside shock on oil prices. That's the reason why we see oil marketing companies not really correcting upwards in spite of oil having corrected from 80 to 72. So marketing margins theoretically have increased, but people don't know whether these margins will be allowed to sustain.